You've been told to diversify. It's the golden rule of investing. But what if I told you that to get really rich, diversification may actually be holding you back? You've heard it from financial websites, financial advisors, some fund managers. Don't put all your eggs in one basket. But here's the truth. The way that diversification has often been sold to you is not the way to get rich. The majority of wealth is not built on diversification. It's built on a few winners. But before you go all in on one or two stocks, let's explore why this isn't practical or safe for everyone, and why for most of us, diversification is absolutely essential. Hi, I'm Alifa, Chartered Financial Advisor, and in this video we'll explore why the rich don't always diversify, why most of us absolutely should, and how you can get the balance just right for your financial goals. Look at any major index, the FTSE 100, the S&P 500, the MSCI World Index. The returns are not driven by broad diversification. Over any 10 to 15 year period, the majority of returns come from a minority of stocks. If we look at recent history, Apple, Amazon, Google, Microsoft, Meta, Tesla, Nvidia have all driven the majority of returns for the S&P 500. In fact, if you had invested in just those 7 stocks 10 years ago, you would have seen returns of 837% compared to the 159% returns that the S&P 500 returned. That's some difference. A real-world example of concentration paying off is legendary investors Warren Buffett and Charlie Munger. Buffett has often said, "Charlie and I decided long ago that over an investment lifetime, it's too difficult to make hundreds of smart investment decisions. Therefore, we adopted a strategy that required us to only be smart a few times. Indeed, we settle for one good idea a year." Their approach wasn't about spreading investments thinly across many companies. It was about making fewer, more informed decisions and sticking with them for the long haul. This philosophy led to monumental success, such as their investments in Coca-Cola, American Express, and more recently Apple. While diversification protects against catastrophic loss from one bad investment, it also dilutes the potential outsized gains from one single phenomenal investment. If you own the market, you get market returns, not exceptional ones. So yes, concentration can build serious wealth, but it's a high-stakes game which most of us can't afford to play. So let's look at why you absolutely need a diversified portfolio. Betting on a few big winners only works if you pick the right ones. And no one, and I mean no one, gets things right all the time. And for most of us, we'll get it right only a fraction of the times that we get it horribly, horribly wrong. Let's take BlackBerry. In the late 2000s, it dominated the markets. And then, poof, gone. Disrupted, forgotten, and for investors, painful. And the same with the UK's darling Carillion. At one point, it was a FTSE mainstay, and then it imploded. Or even Vodafone. The share price of Vodafone today is less than a quarter what it was in the early 2000s. Imagine holding your retirement hopes in one or two companies, and it's gone overnight. So while concentration could help you build serious wealth, diversification is what helps you keep it. So let's talk about the theory behind all this. Investment pros love to talk about risk, and specifically 2 types, systematic and non-systematic. Unsystematic risk is the stuff you can diversify away from. Think, one company goes bust, one CEO loses the plot, or to be more specific, let's call this the Elon risk. So this is the Elon risk, where one tweet, one interview, one bonkers product launch can send the share price into a tailspin. So if you're all in on Tesla, you're in for a wild ride. But if you're holding 100 different stocks, Elon can do what he wants, and your portfolio just shrugs. But here is the thing, diversification only helps with unsystematic risk. When the whole market crashes, you still get hit. And that is systematic risk. Nobody escapes that, not even the perfectly diversified portfolios. So diversification smooths the bumps, but it doesn't build a crash-proof bunker. It just means one rogue billionaire is not going to ruin your retirement. And this is the core benefit. Diversification protects against the you lose, you go broke scenario. It's about reducing volatility and safeguarding capital. Now let's talk about something that doesn't show up in a spreadsheet, and that's your behavior. Diversification isn't just about risk management on paper. It's about helping you stay the course when markets have a wobble. When you're diversified, you are less likely to panic sell because no single stock is likely to blow up your future. And let's be real, most of us are not Warren Buffett. We don't have 40 hours a week to sit and analyze company earnings or bet the farm on one single stock. Most people do not have the time, the expertise, or the capital to do deep due diligence on concentrated bets. They also can't afford a total loss. The ultra wealthy, they can afford to be wrong. It's not the end of the world. They've got analysts and access, and frankly, enough money to lose a few million without blinking. But for the rest of us, losing everything on one single bet isn't an inconvenience, it's a crisis. So if you're building a retirement plan and not a weekend in Vegas, diversification is what keeps you in the game. It's about getting sufficient returns, not swinging for the fences. And by the way, when we talk about diversification, we don't just mean owning Apple and Microsoft. We can also talk about diversification in terms of spreading your assets across different asset classes, things that behave differently when the economy shifts. Stocks give you growth. Bonds, traditionally, income and stability. Property can add a layer of inflation protection. Commodities like gold can zig when everything else zags. And then you've got alternatives. Think private equity, hedge funds, peer-to-peer lending. And if you want proof, just look at this. This chart shows how different assets perform each year. And as you can see, it's investment musical chairs. One year it's emerging markets on top, the next it's bonds, the next it's gold. And that's the point. You can't predict what's going to win. But with diversification, you don't have to. Trying to pick next year's winner is a mug's game. Diversification is a way of owning the racecourse, not just betting on one horse. Now for some common diversification myths and misconceptions. Myth 1 is more assets equals better diversification. Sounds logical, right? More stuff equals more safety. No. If you've got 50 tech stocks, you're not diversified. You're just very, very committed to Silicon Valley. If all of your assets are highly correlated, you're just holding more of the same thing. Myth 2, diversification guarantees returns. Now, while diversification reduces your risk, it spreads your exposure and means that one bad apple doesn't ruin the barrel. It's not a magic shield. In a broad market crash, everything falls. Stocks, property, even bonds. Diversification can soften the blow, but it can't protect you from the hit altogether. It's like airbags in a car crash. It's going to help, but you're still going to feel the impact. Myth 3, diversification only means stocks and bonds. Stocks and bonds are part of it, but they don't have to be the whole story. Diversification could mean a classic bond equity split. However, you could think about spreading across different asset classes that behave in different ways during different market conditions. This could include things like peer-to-peer lending, private equity, gold or other commodities, and hedge funds. The idea is that when one part of your portfolio is struggling, another part may be holding it up or even doing well. And myth number 4, diversification is only for the rich. Not true, not even close. These days, you don't need a fortune or a team of analysts to build a diversified portfolio. You can get access to hundreds, if not thousands of different companies through the use of one single fund. And that's the power of ETFs and mutual funds. You can be instantly spread across region, sector, or asset class. So no, diversification isn't just for the rich. It's for anyone that wants to manage their risk, even if they're starting out with a little. Diversification isn't all or nothing. It's not about being 0% diversified or 100% diversified. It's about finding the right mix that suits you, your goals, your timelines, and your tolerance for risk. Now, are there times when a more concentrated approach might be appropriate? Yes, but only if you've got 3 things: a genuine edge, strong conviction, and capital you can afford to lose. This is not for your retirement pot or your kids' school fees. This is, I understand the risk money and I'm willing to lose it all. If you're saving for retirement, trying to build an emergency fund, or would just prefer a lower stress investment approach, then prioritizing diversification makes a lot of sense. As we've already seen, market returns over the long term are actually pretty good. So remember, this isn't about chasing the highest returns. It's about building something steady, reliable, and that's built for the long term. So what does smart diversification actually look like, and what are some practical steps you can take? Well, firstly, allocating your assets based on your age and goals. Younger investors, or those with a longer investment horizon, may tilt more towards equities, whereas older investors may want to have the stability that comes with fixed interest or bonds. Consider using low-cost, broad market index funds or ETFs, which give you instant access to hundreds of different assets. Rebalance regularly, not obsessively, but enough to keep your portfolio in line with your original plan. And most importantly, know your own risk tolerance. If you can't sleep at night, the returns are not worth it. Diversification isn't about dulling your portfolio. It's about protecting your future. Find your balance and stick to it. So to conclude, yes, some of the biggest fortunes in history have come from concentrated bets. One big idea, one business, one breakthrough investment. But for most people, especially those without unlimited capital or insider level information, this is a high wire act with no safety net. Diversification may not make you a billionaire, but I've seen it make plenty of my clients, millionaires or even multimillionaires, with financial peace of mind, resilience, and a long-term plan that actually works. Take a minute to think about your financial goals. Forget what everyone else is doing for a second. What do you want from your money, and how much are you willing to risk to get it? The answer doesn't need to be dramatic, just honest. So what are your thoughts on diversification? Let us know in the comments below. And if you found this video useful, please like, share, and subscribe for more insights into building real wealth.